This is InvestTalk. Independent thinking, shared success.
Hi guys, great show. I was calling up to see what you guys think about Duolingo, see if it's worth investing in, or should I just move on and find something else? I'll be listening on the show. Thanks.
Okay, Duolingo is that app with the little bird. Let's pull it up here on FactSet. And it is a company that started as a software company for teaching people languages, right? They offer school, free web-based tool that aims to make it easier for teachers to use their platform in a structured learning environment. The bird yells at you when you don't frequently enough study whatever your language you're trying to study. But the reason why this name has had a lot of relative strength improvement since about mid-2023 was on the back of their AI-focused reformation of their company, right? They had an AI-driven expansion where their goal was to put AI first in every part of content creation. Now, there was a little bit of backlash there because they were replacing contracted human content creators with these AI creators instead. But at the same time, they used generative AI to launch 148 new language courses. And so, in spite of this company being down 48.15% in the past 3 months, it's still up 28.87% in the past 52 weeks. It was up 218% in the year 2023. Now, investor sentiment around this has kind of changed a little bit, right? What you're looking at for most of any industry that has started to implement AI within their business is finally getting some monetization from it. In Q2 2025, earnings did beat expectations by a little bit, about a 33-cent surprise on earnings and on top-line revenue, about a 5% surprise there. But there was a pretty significant drop recently, right? You see it about the middle of June. Pretty significant drop here. You had some downgrades. You had a 12% slide in 1 month, subsequent 8% slide there, leading to that 3-month downward movement of 48.15%. But a lot of that is bringing it from some ridiculous highs. In spite of this drawdown, still trading at 63.8 times forward-looking earnings, 12.8 times price to book value, 39.8 times price to cash flow. Now, for this type of business, one of the reasons why I do not like buying something at this crazy of a valuation is that, yes, they have 10.9 million paid subscribers as of June 2025, but it's not very sticky. Except for when the bird harasses you that you haven't done your language lessons for the day, sometimes people don't find an incentive to continue these things. And not a really wide moat here, not a big moat here. If you've ever looked at this app, sure, there are studies that tell you that it doesn't do as good a job at actually teaching you how to be fluent in a language. That's besides the point. But I mean, it's pretty basic stuff here. And so alternatives could pop up, especially with better implementation of AI from the ground floor rather than trying to replace. And because of that, I just think that there are a lot of threats from competitors that exist now and new entrants to the market as well. And so even though it's drawn down 48.15% in the past 3 months, trading where it is right now, albeit far lower than its average priced earnings of 669 times, still a bit too expensive, a lot too expensive for me. That is Duolingo, ticker DUOL. Thanks for the call. Every day now, we receive questions over on our InvestTalk YouTube channel where we not only post content from this show, but we also have a bunch of other educational content that you can only get over on YouTube. You can get it for free, but you got to go check out our YouTube. And this question came in on ticker ICU. It says, I know you guys are big fans of medical devices sector, so I wanted to get your take on ICU Medical, ticker ICUI. Alrighty. So I guess that's ICUI. There it is. And what do you want to know about ICUI? It says it's down about 20%, and I've seen some conflicting reports on future earnings revisions. Would love to get your take. Well, ICUI engages in the provision of innovative medical products. They're based in San Clemente, California. It's a leader a leading global developer and manufacturer of advanced medical technologies. So they have infusion pumps, they got IV sets, they got needle-free connectors, oncology drug delivery systems, the whole shebang of things that you might need in the intensive care unit, as it looks like. Really strong Q2 2025 results, adjusted EPS at $2.10, beating the $1.50 consensus, revenue at $548 million, slightly above estimates. Gross margin improved to 38%, up from 35% the previous year. It is a $3 billion market cap company. It's got about $1.575 billion in debt. Full year guidance adjusted a bit downward a couple months ago, which could be one of the reasons why year to date it's down about 15.42%. Now, its margins have improved, but in 2022, 2023, and 2024, it lost money. Its net margin sitting about 7.9%. Revenue growth, 13.4% going back to 2019. But honestly, pretty much nothing since 2022. So here's a company that is not growing much, that is oscillating between profitable and unprofitable, whose relative strength has been weak since 2019, and has quite a bit of debt on its balance sheet with really not that much free cash flow. So for ICUI, which is ICU Medical, gonna take a pass. Thanks for the call. Or thanks for watching.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos.
Hi, this is Matt in Miami. Love what you guys do. Always recommend your podcast to all my friends and family. I'm curious your take on a stock, LUGDF, Lundin Gold. It's actually on the OTC market. I'm wondering if I'm about to get in a little bit too late. It has a mine in Ecuador called Fruta del Norte. And the numbers for it seem really strong over the past 1 to 2 years. They have no long-term debt, but I always remember you guys mentioning that you have to be careful with instability in a country when it comes to miners. And this one is positioned in Ecuador, like I mentioned. So I'm just curious your take on the stock and kind of forward-looking projections, and even the possibility of this eventually maybe coming to New York Stock Exchange. Thank you so much.
Okie doke. So this is LUGDF. It is Lundin Gold, spelled Lundin, not London like the city. And surprise, surprise, it operates as a natural resource mining company. 100% of its revenue is coming from its mine in Ecuador. Its mining operation in Ecuador, that Fruta del Norte mine system. And revenue has grown pretty significantly, from a whopping zero in 2019 to 1.193 billion in 2024. The price is up 238.33% in the past 52 weeks, up 217.62% year to date. The past 3 months, they had a Q2 earnings beat, 110% free cash flow growth year over year, which is wild. Strong year to date revenue, which is also pretty significant as well. I think they had earnings grow something like 50% year over year at the same time. And so, in the short term, I wouldn't say it was played out right, because there's still a ramp up in operations here. But I think that this is a company that is a gold miner. And so any revenue growth, any margin growth, any net income is entirely tied to the price of gold. Now, we've spoken on this show pretty frequently about the reasons why it is essential to have gold as a balanced part of your portfolio. With higher inflation, issues around Fed independence. Goldman Sachs saying that if Fed independence was threatened, gold could climb to $5,000 an ounce. It is just critical for diversification purposes and also for the return potential over the next decade. Now, in order to do that, you can either buy gold directly, or you can do, as the caller is trying to do, get into a miner. And so that's just to say that all these miners are generally going to have revenue track in the same way. This one is special in that it had a little bit of a ramp up, strong operational throughput, strong growth, 136.7 thousand ounces in sales. But the problem I have with this company isn't that you're late to the boat, it's that it trades OTC. And when you trade OTC, you tend to get worse prices. Why? Because liquidity and volume are significantly less. It trades about 40,000 shares average daily volume, whereas highly liquid stocks trade in the millions. And so understand that means spreads are wider. And as you mentioned, there's a lot more risk because it's concentrated in one country, in one mine system. So I love the idea. If you're willing to take the risk, I don't think it's fully played out. But if you're trying to invest in gold and gold miners, I would probably focus on one that has broader diversity rather than being focused in one country. I would also stay on exchange for those liquidity reasons. That is Lundin Gold, ticker LUGDF. Thanks for the call. Let's shift gears a little bit and talk about today's jobs numbers. The US added only 22,000 jobs in the month of August. What was the expectation? 75,000. And so this difference, this gap, which could be revised up, could be revised down, signals a sharp labor market slowdown. Not only did this number not meet expectations, June's job gains were revised down to a net loss of 13,000, marking the first monthly decline since 2020. Unemployment rose to 4.3%, driven in part by weak hiring across manufacturing, finance, and professional services. And since Trump's Liberation Day tariffs in April, average monthly job gains have dropped to just 26,750. Minority unemployment seems to be a bit down. Black unemployment jumped to 7.5%, the highest since 2021, and long-term unemployment increased as well. Private sector job growth came mostly from the areas that we have seen for quite some time now, over a year, from healthcare, which added 46,800 jobs despite the broader economic weakness. You're seeing it in healthcare, you're seeing it in some services. Primarily where job growth is focused over the past year, government job growth has also been a boon to employment. This time, however, federal employment dropped by 15,000, though many of the recent layoffs that we have seen in the news won't really show in data until the severance runs out a couple months from now. And so what does this mean for us as investors? Well, we talk all the time about the Federal Reserve's dual mandate. It's really three, the last one being the stability of the financial system. But it's being worried about growth, labor, and inflation. And we've gotten into a situation now where the labor market is clearly deteriorating. The economy is softening. Maybe not enough to cause a recession, but certainly softening. In fact, the market now fully expects a Fed rate cut in September. But investors, including myself, are skeptical about how much it will do and if the risks really outweigh the benefits. If you look at inflation, which has been systematically above 2.5%, let alone the 2% Fed target, cutting rates now could potentially reignite that. Now, it could stimulate the labor market, but really there isn't demand for new jobs. The big impulse is automation. It always has been. People talk about globalization taking jobs away. It's always been automation. That has been the singular driving force over the past 20 years that has sought to and worked to eliminate jobs. And so these companies that are spending billions and billions and billions and billions of dollars on AI in order to implement it within their systems, within their companies, are more likely to go down that route with the cheaper capital than they would be to hire elsewhere. Now, we've talked about some of the issues with the jobs report, the quick, which you could have caught in last week's newsletter, on generally why these revisions happen, these data revisions happen, is because, and this has been going on for decades, the Bureau of Labor Statistics has pleaded, change the way you're doing it. It's antiquated. We send out paper surveys. We fax things. And it's difficult to get companies to respond to them. And so if fewer companies are responding, each individual response has more of a weight. And if they're responding later, then when that response comes in, it still affects the month in which it was sent out. But with fewer respondents, that effect becomes greater, hence the revisions. Now, potentially, the new nominee for the BLS has floated scrapping the monthly jobs report entirely. That raises concerns about the Fed, who is trying to be data dependent, all these policymakers making decisions, maybe quarterly is too much of a lag there. Either way, the clear thing here to note is that the labor market is clearly deteriorating. How much effect a Fed rate cut in September may have to float that is yet to be seen. Swing back to the InvestTalk voice bank for a call that came in earlier.
Hello, InvestTalk. My name is Brian. I'm from Ohio. I'd like to see what you thought about the stock Stanley Black Decker, ticker symbol SWK. I'd like to hear what you think the fair value price is on the stock, and also what you think how it might do in the future. Thank you.
Stanley Black Decker, I think I actually have a drill in my closet from Stanley Black Decker, is a power and hand tool company, a very old company headquartered in, I want to say, in Connecticut. They IPO'd back in 1972, been trading for a while, but over the past 5 years, relative strength started to dip in 2021. Interestingly enough, when people were starting to spend money again. Now, a lot of the home improvement did happen during the pandemic, and relative strength did maintain during that period of time, but it hasn't quite caught back to those levels. In the past 52 weeks, down 20.27%. Past 3 months, up about 20%. What drove that in the past 3 months? A bit of margin recovery, analyst upgrades on quarterly earnings. You're seeing here net margin, which was negative in 2023, starting to creep back up a bit, right? Projected to go up to 4.6% from just under 2%. During 2021, again, a lot of people doing home improvement stuff, about 10.3% net margin. So not quite near where it was historically when it was great, but still improving. It's an $11 billion market cap company. It's got about $6 billion in debt. So quite a bit of debt there. Free cash flow not headed in the right direction. Net operating cash flow not headed in the right direction. Debt, though, they are paying off their debt a little bit. Not much cash on their balance sheet either. Just under $300 million on their balance sheet. What they have been doing is trying to improve profitability, which certainly they have. You see that in their margins. They have been cutting costs. And, in the short term, there's a bit of a sensitivity towards interest rates here. Not just because major projects and such and consumer purchases tend to be predicated upon what the cost of debt is, but because small caps are asymmetrically exposed to risk of financing with debt. So you see, right, bad jobs report, potential for 100% according to the market, chance of a rate cut. What does that do? Small cap stock here up 4.02% in a single day. Again, in spite of that, still down 2.3% over the past year. Revenue, flat, down actually since 2022. And because of this, it's trading pretty cheap. 13.8 times forward-looking earnings, 14.9 times cash flow. I don't know. It's a turnaround in progress story here. I don't think they've quite turned it around. Certainly they have a lot of work to do. Their margins a bit expanding, but their cash flow problems seem to still be a problem. And most importantly, their growth has not been regenerated. Probably in the phase of stopping the bleeding, not quite in the phase where I would want to dive in just yet. That is Stanley Black Decker, ticker SWK. Thanks for the call.
Enhance your investment knowledge. Subscribe to the KPP Premium Newsletter for access to exclusive content and expert advice.
We got time for one more question here before we head off for the weekend, and we chose one fresh from our YouTube channel. It's about processes for when you decide to sell shares. The question states, I am very interested on your guys' process for when you decide to sell shares. I've been recently taking some gains from Google and Microsoft after buying during the April lows. I understand that taking a gain should be when you feel the business doesn't have any more potential to succeed, but at the same time, there was so many unpredictable events that could send the stocks down. All right, so we construct portfolios from a top-down level. So you think about, what is your worldview? What does your worldview say about what sectors should do well? What is then within that area? How do you determine what subsectors are likely to be most affected by the macro environment in which you see? And then from there, we kind of do a fundamental approach in which we find stocks that are tilting towards small caps, profitability, value, and looking at those factors create an opportunity set of names. So when those stocks are no longer there, either that they are not as profitable as they were when you had them in your universe, or when they are not as value oriented, maybe they're really expensive now, they move towards growth. That style drift is typically when we look to sell shares. Now, that's at a high level, divesting from the company in full. And again, a lot more to it than that, trying to give you a high level understanding here. Now, when you want to continue to hold on to the company, it's important to set and keep to tolerance bands, okay? If you have a 4% weight in your portfolio that you want Microsoft to have, and you're doing really well, and it creeps up to 6%, and your tolerance band was at 1.5%, sell the darn thing. Be disciplined. A lot of people round trip holdings because they do not trim when they are profitable. Very tough question, right? Lot to answer there. Just a little high level. More goes into it. Certainly one of the most important things. A lot of people know when to buy. Not a lot of people know when to sell or trim. Thanks for the call. Looks like we had a live call. Robert got a listening on AM. I'm sorry. Calling from
Luke.
Pleasanton and listening on an AM 1220. You got a question about Lulu?
Yes, sir.
Lululemon, rough day.
With this big drop today, what are your feelings? Do you think it might be an opportune time to pick some up now?
You know, I have never been pretty high on Lululemon. The reason being is I used to love Lululemon back when they first came out. Very comfortable sweatpants. From a company perspective, I noticed that the quality has kind of degraded over time. And that's just me personally touching these pants and saying I don't like them as much. And that shouldn't really inform our investment decision. But really the thing that hits me with Lulu is they came up in a time when athleisure wasn't really relevant. It wasn't prevalent at all. They created this market around a type of clothes that was both gym oriented, more fashionable. And as with any other product, other entrants came in. And you have your Viore, you have your more athleisure versions, more premium versions of the Adidas brand. You have all sorts of entrants into this market, such that if you looked at corporate earnings here and you look at the guidance from Lulu, a lot of the issues here were company specific. It didn't really make a comment on consumer spending, which has been pretty robust. You see that in household surveys. You see that in a lot of other places. That's why Lulu specifically was down 20%. It didn't drag most of the market down with it. It's been down about 56.12% year to date. It's now trading still not at its low in terms of forward-looking earnings, 14.3 times. I just think for Lululemon, the structural issues here, and it doesn't mean it won't bounce here, but the structural issues within the industry where they are no longer the only game in town in terms of premium athleisure. Again, you got your Viores, your Alos, all these other brands. I don't know. I think from a long-term perspective, its best days are likely behind it. That is Lululemon Athletica, ticker Lulu. Thank you for the call, Robert, and enjoy your weekend. I'm glad Robert called. I hope he enjoys his weekend because I wanted at least one live call before the show was over, and we got it. That being said, my name is Luke Guerrero, and Justin Klein and I thank you for listening to yet another InvestTalk episode. If today's show made you think about your own financial picture, your investments, your taxes, your retirement, whether it's all really working together, give us a call. At KPP Financial, we offer no-cost portfolio reviews to help bring clarity and confidence to your investing. Just go to investtalk.com and click on the portfolio review button. We would love for you to share this program with at least one person in your life who you like and who you want to help become a better investor. Tell them that they can get their episodes at Spotify or iTunes, as well as checking out our videos on YouTube, where we have YouTube-specific content for educational purposes. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.